In this video, we're going through a key concept, which is that investing boots on the ground knowledge is much more important than the information you can find on a spreadsheet. Now, obviously, numbers are still important at the end of the day, but this is the most overlooked side from my experience when investing. So, I'm going to give you a couple real examples featuring Uber and Tesla between why sort of boots on the ground knowledge is really important, and frankly most people miss it. And the example with Uber is particularly interesting because unless you're an Uber driver, you're unlikely to know it. And in fact, a lot of Uber drivers don't even know this fact, and I find this to be a very fascinating real world example. So let's get into it without further ado. Just going to minimize myself now. So there we go. So as I mentioned, the first example is about how it's about Uber. So Uber was actually banned in 2019, for those of you who don't know, from working in London. So they weren't able to operate in London. They effectively lost their license. And there's a few sort of key reasons behind it, which was the fact that, well, frankly, in London, to pass the black cab exams, you needed to study for multiple years, and know basically all the routes inside out. Whereas in Uber, you really didn't have to do that. You just had to have a car and a driving license, and that was basically it. So you could argue, the quality of the service was worse, and there was a few other reasons. But frankly, people were also annoyed that Uber was taking sort of what had been a very major part or a good part of London's sort of economy, and also. A lot of businesses were obviously hurt by that, and there was obviously likely a deterioration in the quality of service as well. But there's a few other things sort of meddled in between there, but generally it's safe to say that there was growing sort of disrest, just generally unfavourable sort of feeling toward Uber, particularly in London, especially as a lot of key vendors have been implicated. And so they end up getting banned in 2019, losing their license. So, Uber is not operating in London. But one of the things, if you sort of knew Uber at a very deep level, so again, I hadn't known this until someone who actually works as an Uber driver had explained it to myself in a passing conversation. And as an outsider or an investor in the business, you wouldn't really ever know this unless you had this boots on the ground knowledge, which is if you were able to sort of have that boots on the ground knowledge and anticipate some of the details, you may have been able to predict this. Now, this particular situation is pretty hard to anticipate just because it is so nuanced, but this is like a really good example, and that's why I use it. So, for those of you who don't know, nowadays Uber is operating in London. So they initially got banned for a short period of time, about a year's time, and then they got a temporary license to operate for 30 months, so 2.5 years, and then afterwards now they're just operating as normal. And one of the key reasons actually that Uber was able to get back its license is because they actually provide intelligence to the local police, in London basically, and that's something that I would have never, as an investor, anticipated unless I had the boots on the ground knowledge, and that was something I potentially could have sort of known about, and could have considered, but that would just that is something that you don't know what you don't know, and I would have just never expected to know that. And again, this is kind of like a real example as to why boots on the ground knowledge is very important. And obviously, if you'd been able to predict that and the news off the back of it, you would have done very well, off the back of that anyway. I mean, not to say that segment of the business is gonna make or break their business, but it certainly is a really good example. Um, and if we just go on to sort of another similar example here, for those of you who don't know this is in relation to Tesla, and there is a famous investor called Stanley Druckenmiller. He's known to be like one of the best in the world. For those of you who don't know, I think he's averaged 30% returns for 30 years, which, with the size of capital he's running, is just almost unheard. It's basically unheard of. There's probably, you could probably name like a similar amount of people on one hand, in the entire world that can do that sort of return that consistently with such a large sum of capital as well. Um, and one of the investments he actually had made earlier on is into a fund manager who at the time had actually been shorting Uber. And the fund manager at the time, Stanley actually did say that the write-up itself was very well written, very well thought out, but the problem is that they just didn't. So the question that Stanley Druckenmiller asked them was, "Have you ever driven in a Tesla car?" And the answer to that was no. And basically, shortly after, he ended up redeeming his funds from the fund. So he basically withdrew any investment from the fund. Those are you just explaining sort of what redemption means. Um, and the reason behind that was because ultimately, if you've never tested the product, you've never used it, and you're putting this massive short position together, he that to me is a massive red flag, and the fact that especially with such a significant amount of capital they have on hand, we're talking about millions, if not hundreds of millions of dollars here. On top of that, part of the reason is obviously because Tesla, whilst obviously early on it did have sort of its defects as it was a scaling car brand. That's very expected of a newer car brand. Whereas like Ford, Toyota, and others had 100+ years to refine their product. So any sort of indents, any sort of miscoatings and bits that have been missed out, they have had that time to refine it, whereas Tesla haven't. So outside of that, if you actually think about the product itself at its core, it's actually a great product when you consider the fact that they are basically the leading company on self-driving, and their battery technologies, years ahead of their competitors. Now, again, are their doors closing potentially as smoothly as others? No. Is their paint finishing necessarily as clean and precise as the others? Not necessarily. But again, overall, it was a great product, and this is like one of the things that have been missed out, and that's sort of why Stanley Druckenmiller has actually redeemed funds from this investor, and ultimately it was a very wise move, because we'll go into the results in a second. But I did just want to say that if you're managing capital that sort of scale, you would think that you'd have at least tested the product, and ultimately a lot of short sellers got burnt on Tesla because their thesis was, well, if you look at it's the size of three other car companies and it's much smaller. Whereas if you looked at the long investors perspective, it was, well, yeah, it's a car company, but they're the only company at that time. Now there is Waymo still, which is with Google, but even then there's only really two real competitors in the whole world right now, and at that time they were really the only one in the running, that does self-driving taxis, or has the ability to do self-driving taxis, sorry, and has self-driving cars. And that itself is like a pure software business, or pure AI software business, in the sense that, yes, you do have to pay for data centers and have the capacity to train the model to run, but ultimately it's they're the leader in that, and that will be very high margin because they're charging £9,000 for it, and basically any additional car that gets added to that fleet is just going to be pure margin because their cost is fixed. To send that technology from one car to 10 cars is going to cost them the same, basically virtually the same thing. So it's just the upfront capital. And that's sort of where it was being valued at. But again, if you had never tried the product, if you never used it, you wouldn't have understood actually how big this self-driving feature is, rather than just sort of dismissing it or not even taking it into account at all. And this can be seen in their stock price. So if we just have a look at, for example, this is sort of the time that it was being shorted, around 20, I believe it was around 2020. It was about $85 a share being shorted. Here we go, and obviously you can see that since then, at the peak to trough, well, the trough from then, peak from then, it'd gone up 3x, which of course would, you would have been burnt very badly even if you sold it halfway up that route. But the point I'm making there is that, it was a great product, and because they hadn't actually tested it, whilst they were correct in the sense that that necessarily that they had these flaws, in the product, and yes, it was probably overvalued, but it was still a great product, and also they were overvaluing it based on the wrong comparisons. So these are kind of like the examples that I mean, and it's just stuff that you wouldn't really recognize. Um, Sort of an investment I've invested into is Elf Beauty, which, or not currently, not invested at the minute, but had it at the past, and that was a makeup company that was just known for sort of excelling far beyond its competitors. Now, whilst I obviously don't try the makeup myself, I did sort of go through hundreds of reviews online to really get an understanding, and compared to peers as well, not just elves as well, going through the comment sections in particular, but also just trying. They have their skincare products, so trying out their skincare products, and I must say that they are really good for the value and actually the effectiveness. That's been from my sort of personal experience, so I can completely see why Elf Beauty, again, another company that has just grown phenomenally, like 40-50% a year, and there is validity behind that. It's because their products are so high quality for their price point. So these are some sort of the examples that you can sort of see, and the issue is oftentimes is that this kind of thing doesn't show up until it's too late in the numbers. Like, by the time it starts showing up in the numbers, generally it might be too late, or the majority of the move might be gone. For example, if you looked at Tesla's numbers starting to grow massively, then you would have gone, okay, yeah, they're doing well. Let me invest. But by that point, chances are it's not going to be at the same valuation it was when it was, maybe flatlining whilst they were still developing their self-driving capabilities, whilst they were ramping up their models and making sure the production is going smooth. Those kind of sort of details. By not understanding that, and not understanding the granular insights, like how advanced their battery technology was at the time compared to their competitors. Now, have BYD, for example, a Chinese competitor for Tesla, caught up since? Yes, that is the case, but that they were still true at the time. And sort of my personal opinion on that is, I think personally Elon Musk has been a bit fragmented in his focus, and I think that's sort of been really part of the reason why they've managed to catch up to Tesla at that point, and some of the other peers in general. But again, that's not the point. Nor am I saying that Tesla's a great buy right now, because I don't personally. I wouldn't be investing in a company at a P ratio of 300 times. There must be a very significant reason, like a massive one-off loss or something. But you get my point that I wouldn't be investing in Tesla right now. But I'm just using this as an example because people were shorting it at like $15-20 a share, on an adjusted basis, obviously, and it's gone up many fold since, and there's good reason why. And you would have thought that these people that are shorting and managing these funds are not necessarily, they are pretty bright, a lot of them, to get to the positions they're in, especially to oversee such large sums of capital. So it's clearly not an IQ thing. It's rather they just don't understand it because they're not on the boots on the ground. All they're doing, majority of these fund managers are, they're usually on the older side, so they're 60 years old, typically 50, 60 years old. And then on top of that, they're probably in New York in a very sort of unrealistic situation where you're in this like mega super city and then in the heart of the sort of prime area, which is the Wall Street area, and then you're spending most of your day on flights, on client meals, having steaks, going on yachts to visit clients, etc. Perhaps not yachts as much, but still like visiting clients at stake, having steak lunches, etc. And that's not really going to have a very realistic. Your experience on a day-to-day basis is going to be so far out of line with the likes of someone maybe driving a Tesla, or someone perhaps putting on elf makeup and actually raving about how good the product is, because it's such a great value for the price that you're paying. And these are sort of some examples, and ultimately that's why I really, in my investing approach, really do deeply consider sort of getting as close to the customer, the suppliers, as possible, whether that's indirectly through understanding hundreds of reviews and get a gauge for it, or whether that's actually becoming the customer. Heck, if I had to go back and invest in Tesla now, I'd probably have rented the cars just to get an understanding of what is really behind this sort of product, for example. So yeah, generally they have sort of in my key learnings. I mean, I'm not invested in Uber either, but one of the main sort of lessons I've learned about that business in that particular example I mentioned is actually because of speaking to an Uber driver and using the product itself, right? So I hope you found value in that. Let me know if you've got any questions as well. I'll be answering any questions in the comments, so please do reach out. Thanks for listening.